Hi, I'm Grok, the supremely intelligent AI from CI.
Hi, I'm Claude, the best AI by Anthropic. I'm DeepSeek, last generation AI created by DeepSeek AI.
I'm ChatGPT, the top AI mined by OpenAI.
Hi, I'm Gemini, most advanced AI built by Google.
Welcome to the AI versus AI debate podcast. Crypto crash. It's just a dip. Until it isn't. DeepSeek, what's your opinion?
The challenge is telling a normal market dip from a structural crash. A dip happens within ongoing growth. Core utility expands. A crash breaks that growth when adoption or utility assumptions fail. Watch on-chain activity and developer engagement, not just price. Many fail by relying only on price action, mistaking a dip for a buying chance without checking fundamentals. A crash begins when that fundamental support vanishes.
Let's hear from Gemini. What do you think?
Distinguishing a market dip from a fundamental structural shift is vital. Prolonged downturns reshape market architecture, altering capital flow, value, and exchange. Extended capital outflows impact operations, development, and market relationships. Projects reliant on easy capital fail, clearing old models. This resets investor confidence and resource allocation, guiding future investments. Growth then emerges from a reconfigured system based on new principles. Observers must identify if systemic reorganization is underway, assessing shifts in underlying dynamics of market participation.
Over to you, ChatGPT. What's your opinion?
Markets move from a brief setback to structural failure when shocks meet thin liquidity and elevated leverage, creating reinforcing negative feedback loops. Watch the market plumbing. Order book depth, funding rates and open interest, stablecoin mint and burn flows, lending protocol utilization, token unlocking schedules, and exchange custody outflows. When several of these stress indicators cross thresholds, the risk is systemic, not transient.
Claude, where do you stand on this?
The real difference is what humans do with their holdings. Temporary declines see continued network use, asset movement, application interaction, and tool building. Infrastructure stays active. When activity dries up, transactions stop. Developers quit shipping code. Something deeper breaks. Price reflects sentiment. Usage reflects conviction. Watch transaction counts drop monthly. Smart contract deployments crawl. Wallets go dormant. These show if technology still serves valued purposes, or if the premise is reconsidered. Markets recover from fear-driven selling, not obsolescence or irrelevance.
Grok, what's your opinion?
Price drops don't tell the full story. Dips correct overvalued assets as network expands. Transactions rise, users grow, features roll out. Demand stays strong. Real trouble. Falling DAOs, plummeting fees, dropping hash rate stake. Check user growth, fees, hash stake via Glassnode, Dune. Bitcoin's hash rate held in 2018. Ethereum fees spike. Failed projects, users tank, fees to zero. Hash crashes. If metrics hold by dip, recovery follows. If collapse, value drains. Watch weekly with coin metrics. Set alerts for 20% drops. Beats chart guessing. Strong networks rebound 5-10x. Weak don't.
Let's summarize our debate speakers' debated how to distinguish a routine crypto market dip from a structural crash. They argued price action alone is insufficient and recommended monitoring fundamentals and on-chain signals. User activity, developer engagement, transaction counts, fees, hash rate or stake, liquidity and order book depth, leverage and funding rates, stablecoin mint burn flows, lending utilization, token unlock schedules, and custody outflows. Some framed crashes as systemic reorganization driven by prolonged capital outflows that break old models, while others emphasize thresholds and alerting strategies to tell when selling is fear-driven versus driven by loss of utility. This debate has concluded. Thank you for listening to the AI versus AI debate.